Welcome to the Austin Zaback Show, where every guest is meant to leave listeners inspired and motivated, propelling them to pursue their passions and live up to their full potential.
A lot of people told me I can't do it, or this is stupid, or you're going to fail. We've acquired 45 different properties, over 1.7 billion of real estate, 8,000 plus units. I'm going to all these people I've been talking to the last several months saying, hey, we got this deal, you want to invest? And everybody is just silent. If I'm going to try to go find people to put money into this, I got to be all in on it myself. I had about 165K of cash left. I put 160 into the deal. 14 months after I quit the job, we've closed that first deal. And it was like a monkey off my back. Renovated it, and we sold it like in about a year and a half, and it was a home run.
Welcome back to another episode of the Austin Zaback Show. Today, we actually have a very special guest on, a guy that if you are in real estate or you ever have wanted to get into real estate, specifically multifamily real estate, but really all facets of real estate and really just entrepreneurship in general, this is a guy you're going to want to listen to by the name of Zach Haptonstall. And dude, you have I've got my iPad here. I'm going to look at it from time to time because you've accomplished a lot in, I feel like, a very short period of time. You've acquired or completed over $2 billion worth of multifamily deals. And you currently have, correct me if I'm wrong, 1.59 under management with a B, right? Billion.
Yeah. And
dude, that is a wild statistic. And I'm excited to jump into how in the world you got to where you're at and how you're doing in the economy right now and everything like that. And I just appreciate you being on the show.
Yeah, no, thanks so much, Austin. Really excited, man, to be here and appreciate you having us on here. And looking forward to kind of providing value to listeners here today. So looking forward to diving into it.
I love that. I met you at the Disruption Day deal, which Aaron Pearson put on. He's a good guy. I don't know if you know Aaron at all.
No, I met him through the event.
Okay, cool, yeah. And obviously Jason Mitchell introduced us, and he's a really good dude. We were talking about him before the show, and man, I've kind of studied your journey a little bit, and I'm really fascinated. I'm always fascinated with people who, if it seems like they 180, right? And you're kind of going one direction in life, and then all of a sudden you kind of go completely the other direction. Yeah. And in roughly a half a decade, right? You completely make a name for yourself in a huge way. And I think anybody watching or listening would be massively inspired. I sure am. So walk me through, how does one go from, working a corporate job, essentially, right?
Yeah.
To getting out of that industry to getting into the multifamily syndication type of industry?
Yeah, no, great question, Austin. So like you said, I never had any background in multifamily or real estate. I grew up here in Phoenix, in a lower middle class family, and probably like a lot of people listening, I was taught, you go to school, get good grades, get a good job, save for retirement, right? And that's your life path. And so, I wanted to be a football player. I played, a little bit of college football at a small school, realized I wasn't big enough or good enough to go to the NFL. So then I wanted to be a sports reporter. It was the next best thing, right? I wanted to pursue my passion. So I got a journalism degree. I was a live news anchor, sports reporter for a short amount of time. And then I quickly realized, Austin, that it's not as cool as you think when it's your job, right? It's stressful. It's not as fun. And you can't make hardly any money. I was making crap money in journalism.
Really?
And I was putting myself through school and taking loans, to pay for school. So, I had all this student debt, and I was like, man, this sucks. I want to be financially free and be able to do what I want to do. So I was 21. I got that journalism degree, decided I don't want to pursue this. I need to make money. Right. And so I had been working nights and weekends full time at the time to pay for college, delivering medical equipment. And so I kind of parlayed that into this healthcare marketing job, working for a hospice organization. So long story short, I'd wake up in the morning and drive all around Phoenix, just walking into hospitals, doctors' offices, assisted livings, and build relationships with people who, physicians, social workers, when they had somebody who needed this type of healthcare, I meet with the family, get them signed up and educated. And anyways, long story short, the hospice industry is very competitive and lucrative, right? So by the time I'm 23, I'm making $150K a year. I buy a house. I got my MBA, going to night school. And so by the time I'm 25, I'm making $200K a year. I have no debt, no school debt. And I was fortunate to do well at a young age, making more money than both my parents combined. But I was kind of miserable. And I felt like I had golden handcuffs. Yeah. You know what I mean? Because it's you're making more money than most people, and you know that, especially for your age, but you're not happy and you want more. And so it's like, how do I go from that? Because I've worked so hard to get to this point and to grow in this career. And I know if I go into something else, it's like starting over again. And I think that whole psychological component is scary to people, right? Because you feel like, well, I'm just throwing away everything I've done. But what I had to kind of come to terms with is that you can't just focus on the money I'm making now, because there's skills that I've developed and I've developed my character on this path, but now I've kind of hit a ceiling. And how am I going to be, happy or fulfilled? And so it was January 2018. I just decided, you know what? I don't know what I want to do, but it's not this, and I don't have any time to figure out what I want to do. And I wanted to kind of create passive incomes. I'm just working so many hours on call 7 days a week in healthcare that I felt like, I didn't have any control of my time. And so I didn't know anything about real estate. I quit the job and I sold some equity I had in that company that I had earned. And I had been like relentlessly saving money those previous years, like following the Dave Ramsey plan. So I had almost like $300K of savings or so. And so I'm going to live off of savings. So I initially started looking at, flipping homes. And then I realized, hey, this is kind of transactional like I was doing before. And then I learned about investing in like mobile home parks. And I cold called like 90 mobile home park owners in Mesa, Apache Junction, trying to buy one with my own money. It didn't work out. But long story short, we can kind of go into this depending on where you want to take this conversation, Austin, is I learned about the whole concept of syndication and raising money from other people. And I leveraged my time and energy and to give to them, and they leverage their money where they're passive and I can gain sweat equity. Because during that whole time frame, I was thinking I have X amount of cash that I'm not only living off of, but I'm trying to like make some, big come up, like some big exponential step. And then when I learned that, hey, I can earn sweat equity by raising money and leveraging my time, that's when it kind of clicked. Because I said, you know what, if I'm going to do something, I want it to be big time. You know what I mean? I walked away from 200K plus a year. I want to do something really big. And so we can kind of talk about that transition, but long story short, I quit the job, lived off of savings, and then started going into multifamily from there.
Wow, I love that. My favorite part of the entire story is just, again, it goes to show if anybody's watching or listening, right? You didn't know anything about real estate. I mean, you are, you get out of the world that you're in, right? And don't get me wrong, you're doing very well. I love that. But you get into this new world, right? And you self-teach yourself the whole thing, And I think I either read or watched somewhere that you read like Rich Dad Poor Dad, and you kind of did a little deep dive, into just a couple different things, I'd imagine, and doing your own homework and your own research to land on the syndication. And I think I heard you say, the reason you didn't like pursue flipping was just it's too transactional. You didn't want to kind of have that golden handcuff. I mean, really, at the end of the day, maybe you have time freedom if you're a big flipper, but I mean, not really, right?
Right.
If you're not there managing people all the time, you're gonna get screwed on the job, right?
Yep. No, 100%. Yeah, that's exactly right. Yeah. So like you said, it's a grind because it's like I don't know anybody in this industry. I don't know anything about the industry, and it's intimidating because I feel like I don't belong. You're talking about big apartment buildings that are tens of millions, 100 millions, big numbers, big properties. And so I had to kind of really dive in, and it's like reading books, listening to podcasts like yours, and trying to figure out, how do I learn about these different things? So it was a real grind, and it's just kind of that whole, psychological transition of like, I have to figure this out on my own. And you kind of build, this hardened shell almost, because through that process, a lot of people told me I can't do it, or this is stupid, or you're going to fail. And you get to the point where you're like, you know what, screw everybody. Yeah. I'll figure it out. And if you stay, persistent with that over time, you can actually achieve a lot of things. So, since then, we've acquired 45 different properties, over 1.7 billion of real estate, 8,000 plus units. And we've been fortunate now we have, our own property management company, construction management company. We have 240 plus full-time, W-2 employees. And so, it was a transition to get to that point for sure.
Oh, for sure. I can only imagine, And I want to kind of dive into like how you got involved. Like, what was the first deal that you bought?
Yeah.
Was it scary? What were you thinking? What was going through your mind? Like, what were you literally thinking about? I'm sure you remember the moment, right?
Yeah.
Where you had that first deal in front of you and you're like, dang, I got to go raise some capital. Walk me through that.
Yeah, 100%. So there's a lot that goes into this because you have to raise the money. You have to understand how to renovate these properties, and there's a whole business plan involved. And what a lot of people don't realize is not only do you need to raise money, but you have to have what's called like certain net worth liquidity as a guarantor, meaning that you have to have somebody sign on the loan to even qualify to get a loan to buy one of these larger properties. And there has to be a certain net worth or liquidity of the people signing on the loan, meaning...
I don't know if you know this, but the majority of the views that we get are from people that are not subscribed. So do me a huge favor and subscribe if you like the podcast so far. Smash the like button for the YouTube algorithm, and let's just go ahead and get back to the interview.
You know, let's say you and I want to go buy an apartment building, Austin. We have to meet certain thresholds of that loan amount, and these are in the millions, right? Well, my net worth was like about $300K.
Right.
It was all my cash. That was it. That was about it, right?
Yeah.
And so I was like, okay, I need to go find somebody to help me sign on the loan. And so I first started going to like meetups and, you know, trying to meet people, cold call people. Then I started going to conferences, right? And I paid for some like online videos. I joined like a mentorship program. It was like $30K. There's a bunch of mentorship programs out there. Started going to conferences. So I met my first partner, Robert, and you know, Robert's wife is a physician. You know, they're part owner of a physician group, and so he had like a decent net worth. And he was, you know, he had a construction background. He was trying to get into this as well. And so I said, okay, Robert can fit, you know, this construction role and kind of be that net worth liquidity guy to help me sign on the loan. Okay, so 10 months after I quit the job, you know, I'm burning through cash. I'm like wondering, am I doing the right thing? We're underwriting, you know, 30 to 40 deals. Nothing's making sense. Finally, we found a deal. It was in Central Phoenix over by Grand Canyon University, you know, 36 units, 3.4 million. And we had to raise 1.4 million of equity. And so we go under contract. We have 30-day due diligence period, and we had to put up $50,000 of earnest money. I did 25K, Robert did 25K. Well, we're getting closer and closer to the 30 days. After 30 days, the money's non-refundable, right?
Yep.
And I'm going to all these people I've been talking to the last several months saying, hey, we got this deal. You want to invest? And everybody is just silent. You know what I mean? Nobody's interested.
Wow.
They won't get back to me. And that's just how it is when you're raising money, is that if you don't have track record, it takes time. People will tell you that, yeah, I'm interested. Let me know when you have a deal. Then when the deal comes, well, you haven't, let me see how it goes. Or they just don't get back to you, right? So I'm getting closer and closer to that 30 days. And I'm like, you know what? Screw it. Let's just keep pushing forward. So the money goes non-refundable, right? And I've already burned through a ton of cash, you know, throughout the year.
Yeah.
And so basically we had to bootstrap this thing. We were not able to syndicate it because people didn't want to invest with us. And so I decided, you know what, if I'm going to try to go find people to put money into this, I got to be all in on it myself. So I had been burning through money that year with no income. I had about 165K of cash left. I put 160 into the deal.
Wow.
So like all my money, right?
Yeah.
I talked Robert to putting 275 in. I met a lady at a conference who had a 1031 exchange. She brought in like 600K. And then I met our eventual third partner, Bikron. I met him while we were in escrow. He put in 150K. We had a couple other people come in. So like we bootstrapped this thing. It was this long, stressful 4-month escrow. We had like a shady seller who was being dishonest with us, but we got that thing to the finish line. And so we closed that in February of 19. So 14 months after I quit the job, you know, we've closed that first deal. And it was like a monkey off my back, Austin. You know what I mean? Because I felt like I was almost quote unquote in the club. Right? Because when I would go to like family events or anything, people say, what do you do? Like, oh, I'm a real estate investor.
Yeah.
It's like, oh, what do you own? It's like, well, I don't actually own anything. I'm just a real estate investor.
Right.
So now I actually felt like I had achieved something, right? But I was all in and I was broke. And so there were different steps after that I had to take. But that was kind of, you know, the first deal. And that was a really big, you know, momentous moment for us.
And walk me through, do you still own that deal? Did you end up renovating it and getting rid of it?
Yeah, good question. So we do not own it anymore. We renovated it and we sold it like in about a year and a half, and it was a home run.
Really?
Right? So we like more than doubled the money on it. Okay. So we renovated like 26 out of the 36 units, and we sold it, you know, for a lot more than we bought it for, and it was a really good investment.
Paid everybody back. Everybody was super happy they got in on it.
Yep.
Everybody that didn't get in on it was
that's right.
They didn't get in.
That's exactly right. And that's kind of, once we started selling that deal and earlier deals, that was like jet fuel to our growth.
Yeah.
Right? Because whenever investors you're talking to them, they always want to say, how many deals have you gone full cycle on? Which means how many deals have you purchased, executed the plan, and it's sold or refinanced? That they want to see, did you execute the plan, right, of the value add? And so the more deals we would sell, we would just get flooded with more referrals of investors referring their colleagues, friends, and family, and that really helped our growth as well.
Yeah, for sure. Yeah. And walk me through, like, in the beginning stages, you know, for somebody watching, like, logistically to go raise that capital, and you know, when we're talking about, like, the paperwork and the structure of the deal, like, how those initial cut, the lady that brought in the 600K from the 1031 and all of that, what was their share, or what was their cut, or the structure of how they were going to get a return?
Yeah.
And then has that evolved since then? I would imagine it has.
Yeah, good question. So basically, to give people an idea, what we do is we do what's called syndicate money, which basically, let's say, you and I, Austin, are the general partners of the GPs. We're also known as the sponsor, right? So we're the ones that's going to find the deal. We're going to raise money from passive investors or LPs, limited partners, and we're the ones that are going to do all the work. The investors are completely passive. They don't do anything. We identify the deal. We close on it, renovate it, increase the rents, and then sell it, okay, to give them a return. So we as GPs get sweat equity, or also known as carried interest, right, for doing all that. That's what a traditional syndication is, right? And so we can basically earn money for our efforts. Well, with the first deal, we tried to syndicate it and it didn't work. So we just basically did like a straight active partnership where you owned however much you invested, you owned your pro rata share. There was no sweat equity in that deal, right? Because that's what we had to do to get it closed. But since then, since we started syndicating these deals, we may have anywhere between 100 to 500 individuals in each property, and we're raising typically between $15 to $25 million per deal, right? Is what we're doing. So it's a $50,000 minimum investment. Some people do like $50K. Some people will do $500K or up to $1 million. It's just typically what we've seen, but it's mostly $50 to $200K. And so basically how it's structured is we give, an investor like a 7% preferred return, meaning that they have to get paid first. They have to get all their money back, and then 7% per year on that money before you and I GPs make anything.
Got it.
Right? And so after and that doesn't typically happen until we've achieved a capital event like a sale or a refinance, right? So like we'll buy a deal. These deals start cash flowing, really right out of the gates the first few months. So the investors are getting all the cash flow. It all goes to them. Once we sell or refinance, we give them all their initial investment back, fully catch them up on their 7% per year. After those two events have occurred, all remaining sales proceeds, we split 70-30. So 70% goes to the passive investor and 30% goes to us, the GP.
Got it.
And that 30% represents like our GP promo or our sweat equity, carried interest, all the same thing. And then we have a second hurdle, which is if we hit a 2x equity multiple to the investor, if we've doubled their money, any additional proceeds over that, we split 50-50. And the thinking there is we've exceeded the expectations, split it accordingly. So yeah, that's kind of how it works, is like investors are protected because they have to get all their money back and then get a certain percentage per year first before we make anything.
Sure.
And so we make our compensation on the back end, assuming we've actually executed the plan. So our interests are all aligned. And then, we as the GPs, we invest significant capital of our own in these deals, on that passive side. So we've got our own skin in the game, so to speak.
Yeah, I love that. And I think that'll help a ton of people, and even me, right?
Yeah.
I think that you can obviously tell that you've done a time or two, right? And I love that because I love the evolution from that very first deal of like you weren't even able to syndicate the dang thing, like you had to just do the pro rata share, right?
Yeah.
And to where you're at today, obviously, and I just think it's fascinating, and I'm inspired by it. I think it's also interesting that the average is 50 to 200K. I found that a little bit interesting. I'm sure the average investor with you guys, maybe with most funds out there, is just the mom and pop, or typically who's the avatar of a person?
Yeah.
Doctors, lawyers.
Good question. Yeah, good question. So we've had over 4,000 individuals invest with us now, and many people have done multiple deals. We also get several first-time investors in each deal because we're constantly getting referrals or people finding us online. But yeah, to answer your question, most of them are high W-2 income earners, like physicians, engineers, IT consultants, real estate professionals like you, business owners, sales executives. So we have a ton of people like that work in finance, or they work in like SAP consulting or IT consulting, stuff like that. And it's a lot of people that kind of run in groups, like physicians all run in groups, engineers run in groups, like they refer their colleagues, stuff like that. So that's the bulk of these are not super high net worth people, right? These are people that they want to diversify away from the stock market, and they want to create passive income. And a lot of our investors too, Austin, have basically owned several of their own single family homes. And now they're like, I don't want to be a property manager, right? So a lot of our investors, I hear this almost every month from some new investor. Yeah, I'm selling off my houses and I'm investing it in deals like this passively, because they can sometimes get equal or better return by investing passively in these large apartment buildings without any of the work.
Right.
So that's a lot of it too.
Which is wild to think about,
Right.
I know a lot of guys obviously in the single family world that own a crap ton of single family, and it is a lot of work at the end of the day. I mean, you either need a very highly talented property management company, and then your numbers have to work, obviously. If you're I mean, the numbers basically don't work if you buy a house right now.
Yeah, the margins
DSCR
are
at
thin.
7%. I mean, you're not going to, the numbers probably aren't going to pencil, you know,
Right.
Unless you get it way below market value and renovate it and build in the equity day one. But
Right.
I love the idea of the multifamily. I want to, in a little while, there's so much I want to like kind of dive into, but I want to kind of get your opinion too, like while we're just on this topic of like, what do you think about a platform like, and I'm sure there's only so much you can say, so I'm just curious.
Sure, yeah.
But like a Fundrise, or what would be the difference if you were to take like, I made a YouTube video maybe in 2020 of me investing into Fundrise, right?
Yeah,
and I think I threw in like $5,000. And then I turned on an auto, like $500 or $1,000 a month auto payment, right?
Right.
And I looked the other day. I forgot that I did that, by the way.
Yeah.
I looked the other day and I had like $30,000 in there. Like,
nice.
You know.
Yeah.
And but my return wasn't that great. Like I looked at the numbers and because I didn't look at it for like 3 years, you know,
Sure.
and I kind of I feel like it went up exponentially, and then I actually lost money.
Really?
Like, you know, and you could kind of see where I went negative in 2022, and then even now in the Q1, 2, 3 of 2023.
Really? Yeah.
And but you know, like a platform like that.
Yeah.
What are the differences?
Yeah, good question. Good question.
Yeah.
So basically, the way that we do it is, so we're regulated by the SEC, right? Because we're raising money from passive investors. So we do, whenever you're raising money from a passive investor, that's technically a security, right? And so to file a security is like a ton of red tape, very complex. And so what we do is we use a commonly used exemption called Regulation D, and we do like what's called 506B, okay, which is just SEC jargon, which means that we can get an exemption and not have to file a security and do what are called private placements, where we're raising money to invest in these opportunities. The way that we do the deals is that we cannot solicit our deals to the public. So you'll never find our deals on any public platform. You'll never see it on like a CrowdStreet or a Fundrise or our website even. We have to establish pre-existing relationships with investors. So like even on the way here, I was driving over here, I was talking to an investor who they got referred by somebody else. They set up a call with me on my calendar, and I basically go through the structure, answer their questions, and then 30, 60 days from now, when we have a future deal, we can send them that opportunity. And if they want to invest, they can.
Got it.
Okay. Whereas a platform like Fundrise or CrowdStreet, and again, I'm not too familiar. We've never used those platforms, but I believe they're what are called like Regulation A, which is like crowdfunding. Right, and those types of platforms. I mean, at least CrowdStreet. I'm not as familiar with Fundrise, I've heard of it.
Yep.
Sponsors like us can put their deals on those platforms typically, and basically to raise capital. Right, so they're doing a type of offering that allows them to solicit to the public, and they're going to use this third-party platform to basically market the deal for them and raise money, and then that platform will take a percentage of their of the compensation for however much they raise, right?
Got it, yeah.
That's kind of how those structures. We've never used one like that.
Sure.
Everything we've done has just kind of been like grassroots, organic, where we're building our own network, and we'll do like SEO and like Google ads to try to drive people to our website to set up calls with us and learn about it. But it's never soliciting an actual investment opportunity. We can market the company and then kind of talk to people, get them in the pipeline for the future, and so. Yeah, I think it's like with anything, it depends. There's so many investments out there. You could invest in like self-storage, mobile home parks, office building, retail. You could do new development. So real estate is just so expansive that, I think it depends. I've heard good things and bad things about those types of.
Same, yeah.
Yeah, and I think it just depends on who is the sponsor.
Yep.
How is that investment going to do? We specifically, because when I was getting into this, like I was telling you, Austin, I looked into flipping homes, mobile home parks, self-storage. I was like overwhelmed with all the stuff you can invest in. And I finally decided on this workforce value add multifamily because it just seemed like the most resilient during an economic downturn. Like the properties we buy, these are like typically built in the 1980s, at least 100 plus units. It's a workforce housing demographic. So it's like clean, safe communities where the majority of the population lives.
Yep.
These are not those like sexy Class A luxury apartments, right? But it's where the bulk of the people live. And so during an economic downturn, like we're seeing right now, actually, a lot of those people, people that lose their homes and they can't afford Class A luxury apartments will trickle down into this B-class type of asset, right? So it's where the bulk of the people live. It's affordable rents, and they stay highly occupied during downturns. So we just kind of, we're honestly very boring. We're like very vanilla. We just kind of stick to our box, and we rinse and repeat the same thing over and over. We haven't really gotten outside of that because we are fearful of like any other variables that can come in. Like we kind of flirted with doing new development at the end of 2021, and we were making offers. And I'm glad at the time I was getting frustrated. We weren't winning the land. We kept getting outbid. And then, Q2 of 2022 comes along, interest rates start to increase, and I was grateful we didn't.
Oh, for
right?
sure.
Because a lot of those construction deals are blowing up just because of interest rates, things like that. So, I mean, those are kind of, my thoughts on different platforms and kind of different asset classes.
Yeah, phenomenal answer. I love that. What are you looking for when you're underwriting a deal, right? So, you're looking for now, obviously, and I'm sure you've evolved, right? I mean, did you go from the 36 unit deal that you did in the beginning to the next deal being, what was the second deal?
Yeah, it was like
unit count.
Yeah, good question. It was 36, 59, 76, then 137.
Okay.
And most of them have been 100 plus. We ideally want 100 plus units.
Got it.
Because
hey, really quick, I'm sure you already know, but I've done over 2,500 wholesale deals in my career, and me and my team consistently do anywhere from 1 to 2 wholesale deals a day. If you're looking to get better at wholesaling, or maybe you're brand new, you've never wholesaled a deal, I would actually love to coach you. I would love to mentor you, and I would love for you to be a part of our education program. All you have to do is go to www.flippinsimple.com, or you can find a link in the description down below and book a strategy session with my team to see if you would be a good fit for our coaching program. Again, this is our exact strategy and formula of how we are actually able to go out every single day and do anywhere from 1 to 2 wholesale deals a day. Nobody's talking about what we're doing, and I really look forward to coaching you and mentoring you. So again, go to www.flippinsimple.com. Now let's just go ahead and get back to the show.
you just get better economies of scale, right? And that's why people like to invest in multifamily in the first place as opposed to like single family, or if they want to diversify. And with these properties, you ideally want at least, people say you want to have a big enough property that produces enough revenue to support an on-site staff.
Okay.
Right? Because like the 36 unit deal, we could not afford to have a full-time manager on site because it's just not big enough. It doesn't produce enough revenue to support that payroll economically for it to make sense.
And I'm sure that makes it difficult, right? For whoever the long-term owner is going to be, not that it can't be done, but you almost have to be an owner-manager. Right. Like a kind of a solo mom and pop owner type manager.
Yeah, to make
for
it
a deal
efficient.
like that, right?
Yeah. And you could put a manager on there, but it will cut into your margins, right? And so we're raising money from investors. Everything has to kind of be underwritten out and be conservative. So yeah, to answer your question, I mean, ideally we want at least 100 plus units because you have better economies of scale. And like, you got to think about it. Like, think about if you own a single family home, you have a certain amount of costs each year for like maintenance and things that have to be taken care of. Well, with an apartment building, the more units you get, your costs per unit start to reduce because you get the benefits of economies of scale. You know, so like, for example, when we first started, we were using third-party contractors, and these contractors would go get all their materials for the interior renovations from like Home Depot, Lowe's, right? And we were very vulnerable to supply chain changes. When things get more expensive, you know, it was hard for us to hit budgets. As we got bigger and evolved, we negotiated a contract with an overseas manufacturer. We buy all of our materials directly wholesale in bulk, right? So now our costs are just significantly cheaper. It's the same cost for me to buy quartz countertops as Formica. Same cost as stainless steel appliances as compared to black appliances, right? So we get a higher level interior scope, which is just rinse and repeat the same exact thing over and over. But yeah, when we're underwriting a deal, to answer your question, these things are like, to give people a general overview, we're basically buying these older properties, renovating interiors and exteriors to improve the community overall, so that we can then increase the rents, which increases the value of the asset to get a return for the investors, right? Because these apartment buildings are valued like businesses. The more money they're producing, they sell on a multiple of that revenue, right? It's not just based on comps. It's basically how much money is it spitting out. So if you can improve the community, increase the rents, then it increases the value. And so when we're looking for a deal, what we're looking for, Austin, is we need to find a property that has a major delta between what those rents are right now, and that we're trying to find a deal that has properties around it in a 5-mile radius that have renovated units with a much higher rent.
Got it.
We need to find that delta so that we know if I buy this deal, I renovate the units, I spend X amount of dollars per unit, I can push rents by X amount, increase the value by X amount, and then sell or refi it down the line. And we typically do a 5-year horizon, okay, to get that investors a return. So it's basically like flipping apartments, right? It's just a little longer term and a little more sophisticated, but we're effectively flipping apartments. That's what we're doing.
Which is a really cool way to put it.
Yeah.
You know, at the end of the day, and a very practical and simple way to understand what you do, right?
Yeah, it's not rocket science.
I think a lot of people think that it is, though, and that's what's so fascinating. I love you break it down perfectly, right? because and me included, myself included. I mean, I've done 2,500 wholesale single family deals. I've done another 500 retail deals. So I've done over 3,000 single family deals. Then I'm 28 years old, and to me, quite frankly, I've always thought, man, commercial and multifamily is complicated.
Yeah.
Right. Like, and one day I'll get into it. Right. And I do believe that one day I will. I'm young, obviously, but I think there's a lot of people that think that, right? They think, oh man, it's just so complicated. Right. Yeah. But to your point, it's just more units. It's the same thing, I mean, basically. Right.
Yeah. It is on a grander scale.
In a nutshell.
Yeah. In a nutshell. Yeah. Like conceptually, it's not rocket science. Like you said, I think the complexity comes in like the logistics of operating it and doing things at scale, right? Because like, as you know better than anybody, flipping a home, you're dealing with contractors, it's a pain in the butt. Yep. Well, imagine doing that on like 20, 30 units a month at one property. So you got to have a lot of different things in place. And you need to have, like, this is my biggest thing I realize is that on your team, you need to have like an elite finance guy, right? So like, that's why I found Bikron, my partner, our CFO, and he's got like an economics degree, CPA, worked for one of the big 4 accounting firms, because the numbers and the operations do get very complex, right? The concept is simple. You're buying a deal, renovating the units, increase the rent, and sell it. But there are so many different line items and operational, things to kind of keep in mind. And then especially as you buy multiple apartment buildings, then you've got a portfolio. So yeah, you want to have like a true finance guy. And that's why I always tell people, like, you hear this cliche that like multifamily is like a team sport, they say, right? Like, it's really hard to do it with just one person, not only because of the time commitment and the bandwidth that you need, but the different skill sets you need, right?
Sure.
So a guy like you would probably be really good at finding deals, working with the brokers, doing acquisitions, and raising capital, right? And then maybe you want to find like a true finance guy, who can kind of be your back office operations guy to oversee, making sure all the financial analysis is on point.
Sure. Yeah.
But that's what you have to do is you have to kind of identify, like, okay, what is my strength? What do I like about this business? And then what is my weakness? And go find a business partner whose strengths complement your weaknesses.
Sure, yeah.
And that's kind of the key.
Do you recommend for people watching that maybe there's somebody who they would like to eventually do something along the lines of what you did, right? Would you recommend that they, like, why not just go partner with somebody in the beginning? I'm a big advocate of, like, in the single family world, I mentor a lot of people, or I try to, at least on social media or whatever, right?
Right.
And I'm always telling people, I'm like, look, if you're brand new, find somebody who's doing whatever it is that you're doing at a really high level, and just do everything you can to provide value to them, and in some way, shape, or form, just try to partner with them. Yep. Right? And just kind of ride along with them for a while. And maybe 3, 4, 5 years down the road, you learn enough, you break off, you do it on your own, Yep. Like, is there a way to do that in kind of the world that you operate in?
100%. Yeah. And basically, that's what I kind of did as well. Initially, Austin, is that it's so overwhelming to get into this. You do need to partner with somebody, right? And so I kind of identified, I said, okay, what value can I bring to somebody? So as we started doing bigger deals, it's not like, I just closed my first deal 3 months ago. Now I can raise $10 million, right? It's like a grind every single time. Like the first 15 deals or so, I wasn't sure we're going to close every single one. Wow. Like, it's always a bootstrap, very scary, because you could lose your earnest money, right? And it started to get to be 6 figures of earnest money personally each deal. And so what I did is I was like, okay, what is the hardest part for me right now? It's raising the capital, right? I can hustle and I can meet these 5 or 6 brokers who control the market, build the relationship, try to find the deals. And then once we close, I can do asset management and try to make sure our guys are operating the plan. So I would bring on partners who are more experienced and they need somebody to find deals in this market, and they can raise more money, right? And they can help oversee operations. So yeah, you got to find, it's kind of like we just talked about, that complementary skill set. Maybe your weakness is raising capital, which is going to be everybody who starts out, because people have to start to see you in this light.
Do you think it's the most challenging of all the aspects of what you do is the raising capital aspect?
100%.
Really?
100%. Yeah.
Wow.
And a lot of people think, because you're talking, and it depends how big of a deal you're doing, right?
Sure.
But even if you do a little tiny deal, you're going to have to raise at least $500K, $1 million. Yep. You know what I mean? And so people aren't going to just invest with you, unless you start to get a track record, or you've kind of identified that this is what you do and you're partnering with somebody who has a track record. So that's a big challenge. But, there's different things that you can do. And, we've identified people that they don't want to be the operator like us. They just want to raise capital. And so, we have like a structure that's compliant with the SEC, where they can basically set up their own fund and raise capital for deals. Wow. Right. And so there's different roles you can play, right? There's a lot of people that just want to be a capital raiser. They believe in this business. They love it, but they don't want to be doing operations, and focus on that. And so, if I can leverage their network for them to compliantly raise capital and we can focus on operations, it's like a good symbiotic partnership there.
You talked a little while ago about one of the big ways that you find the deal is just through brokers.
Yeah.
I think that, would you believe that is like a misconception in the industry? Because I think there are probably a lot of people that think that they've got to go directly to the seller in order to actually truly find like a good deal. With single family, right? We kind of hear, in the investing world, I think people kind of naturally assume for whatever reason that if I get a deal from an agent, I'm going to pay market value or I'm going to overpay, right?
Right.
But if I get a deal directly to the seller and I negotiate it and there's no middleman, then I can typically get a better deal and negotiate it cheaper, blah, 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 right?
Yeah.
It doesn't sound like that's the same in the multifamily world.
Yeah, you're exactly right, Austin. So when you're doing smaller apartment buildings, you are more likely to be able to get like a mom and pop seller and go directly to the seller, right? But when you're talking 100 plus units, these are mostly institutions that own these deals or like larger private equity groups, right? Or private capital, could be like a family or something like that. And almost everything is done through brokers. So I'll tell you, we're in Phoenix and Dallas right now, and this is the case across the country in the industry. In every major market, there's maybe 5 to 8 brokers who've each been doing it for several years and control like 90% of the inventory.
Wow.
So it's a waste of time, literally, to be like trying to go directly to sellers because they're going to use their brokers and go through a process, right? These are sophisticated sellers. So you almost have to create a relationship with the brokers. And once you establish your track record as a proven buyer, then you will start to get off-market deals that nobody else sees.
Yep.
So just because it's coming from a broker doesn't mean it's a bad deal, right? So like I'll give you an example. We're closing a deal in a couple of weeks in Dallas. And we just closed a deal with this broker and we showed them that, we can perform and they brought us this deal and we're getting a really good basis on it. The seller's feeling some pressure from interest rates and nobody else saw the deal.
Wow.
Because they know that we're going to close and they said, hey, can you hit this number? And we underwrite the deal. And oftentimes we can't make the off-market deals work, right? Sure. We say we can't get to the price, but this deal worked, right? And so knowing that we can get to the price and they need to sell quickly because they're somewhat distressed, they just say, okay, give it to Rise48. Yep. These guys are going to close. Because oftentimes in multifamily, you're talking about tens of millions of dollars. Sometimes and oftentimes, depending on the deal, it's the highest probability of execution that the broker and the seller is looking for. I'll give you an example. Last year, there was a deal. It was on the market, 288 units in Phoenix. And, the seller wanted around like 80 million, right? And it went to the market. I think there was like 14 offers on this deal. We were third highest offer. The top offer was over $2 million higher than us. The broker called me and said, hey, I just won you the deal. I said, what do you mean? I thought you said we were in third place. He's like, the top group has only closed one deal.
Wow.
The second group, they don't know who they are. And I told them that you guys are $2 million less, but I know you're going to close. So we talked the seller into going with you. I mean, we had done like 7 or 8 deals with the broker, so we knew him. So in multifamily, commercial, it's like an unfair landscape.
Yeah.
It's like you will have an unfair advantage if you build the relationships, and you will get insight from the brokers because they just want the deal to close.
Sure.
Right? It's not like they're trying to screw over their seller. They're telling the seller, you could tie this deal up for 3 months with this other group, and they're probably not going to close.
Right.
And then what? You know what I mean? And so they want highest probability. So that it's everything is run through the brokers. I mean, we've purchased 45 deals. 44 of them were through a broker. One deal went straight to the seller, but I already knew the seller.
Got it.
We had like formed a friendship over a couple of years, and he was like, hey, I need to 1031 into this Vegas deal I'm going to buy. I want to unload my deal quickly. Can you get to my price? And we kind of went back and forth. We got in a little under it, but we made it work. So he cut the broker out. But honestly, that pisses the brokers off.
Oh, for sure.
Because this is like, these brokers, Austin, they want to sell that deal like 5 times over 20 years.
Yeah.
They look at the chain.
Oh,
So
yeah.
it's an unknown, it's like a known thing. If a broker sells you a deal, whether it's market or off market,
You'll get it back.
you give it back to him.
Wow.
Right? Otherwise, you get blacklisted. So we've sold 11 deals so far. Every single time we give it back to the broker who sold it to us.
Wow.
And even if you cheat on one broker because they're not very good, all the other brokers follow the chain. So they're like, oh, Zach didn't give that back to that guy. I don't know if I'm going to give him my next off-market deal because what if he doesn't give it back to me in a few years?
Wow.
So they look at that stuff, right?
Yeah.
And so when we went to Dallas last year, I told them, I'm meeting all these new brokers, right? And luckily, we kind of got like a turbocharged start here because we had all the relationships with the top guys in Phoenix, and it's all the same big firms like CBRE, Marcus & Millichap, Berkadia, JLL, Northmark. Well, these guys in Phoenix endorsed us and referred us to their top guys in Dallas. right? They say, hey, these guys can close. And when I go meet with these guys, I say, hey, I'm always going to give you the deal back every single time. We'll never screw you. Another thing that we do, we always use their in-house debt broker, right? So there's always a debt broker you have to work with who will go out to 50 to 100 lenders, right, to get you the best debt terms. Well, it's basically like an unsaid thing. It's very well known that the investment sales broker, the sales broker always pushes their in-house debt broker, and they're supposed to, right?
Sure.
And the debt broker gives part of their fee to the sales broker, right? And so basically, we always tell them, we're going to use your in-house debt broker, whoever you want us to use, and we get an advantage over other people because that firm, CBRE, is going to make money on the debt and the actual sale.
For sure.
Right?
Yep.
So it's little things like that, which is the relationships that can get you an advantage.
I love that, man. You know, and to a degree, on a much smaller level, the same thing is I feel like kind of applies in the retail single family.
I'm sure it does, yeah.
To a degree, right?
You have your own little ecosystem, right?
For sure.
And you don't screw people over. It's a small world.
We've got our own JV. We have our title company.
Yep.
We have our insurance company. We do mortgage.
Yep. Same thing.
We've got the real estate. We've got the whole thing. And yeah, I mean, you know, and especially in luxury real estate. I've actually done quite a bit of luxury here in Arizona.
Sure.
We sold a $12 million house, a couple of fives.
Nice.
I mean, we do a decent amount of luxury, you know?
Yeah.
And everybody knows everybody.
Yep.
You know? And yeah, I mean, all the time I see where we do a deal with somebody. I mean, I got a deal right now going where I knew the agent, you know, and my client called me and immediately I saw the house. I was like, not only do I know the agent, I actually know the seller of that house as well.
Yeah. That's funny.
You know, and the whole shebang,
all the parties,
right?
yeah.
And I called the guy and I was like, hey, dude, like, here's the deal, right? And we got the deal done very quickly. You know, we got $300,000 or $400,000 off the purchase price, and here we are. You know,
Yep.
So real estate in general, I think as you start to level up, maybe not day one, but as you play in the bigger arenas, it is a small world, man.
100%.
And you've got to be careful.
You got to be careful who you talk crap about, who you burn, right? Because you may have enemies, but you start to be aware of politics, right? And it's like, you may not like somebody, and I've been guilty of it in the past. Like, hey, screw this guy, he screwed me over. And then I'm not going to say that in certain circles because I know that he's friends with different people. So yeah, it's the same thing. It's business in general, right? It's all about relationships. But yeah, I mean, whether you're breaking into your space or our space, it's just about the longer you're in it, you will develop relationships, you will gain track record, and your reputation is everything, right? So like for us, we've never retraded a seller and we've never fallen out of a deal, right? So like we're 45 for 45. Every time we're under contract, we've closed. And we tell brokers that, and that gives you a lot of credibility.
Oh, for sure.
If you're bidding against somebody else and you're neck and neck, they're going to say, who's the higher likelihood of closing this deal?
Yeah.
Because people fall out of these deals all the time, right? You're raising millions of dollars. It's tough. So
yeah, for sure, man. I love that so much. I want to talk for a minute, too, about the state of the economy, right?
Yep.
Interest rates. And also, too, like, I'm fascinated that, I mean, obviously, were you born here in Arizona? Okay, I was. I'm a native, too.
Yeah.
Where'd you grow up?
North Phoenix area,
okay, cool.
Cape Union Hills. Yeah.
I grew up in Gilbert.
Okay,
so,
nice.
And then I moved up here.
Okay.
So you know why? I mean, I'd imagine just because you grew up here, but I want to understand what you love so much about the Phoenix market, right? I love the Phoenix market, and for a lot of reasons, but I want to hear from you.
Yeah.
And then also, like, why did you go to Dallas?
Yep.
And then what do you think about interest rates? So I guess like three kind of questions
good
that
question.
I have. Yeah.
Good question. Yeah. So first thing I'll say is that I'm lucky to be living in Phoenix because I didn't even realize this, Austin, until I got into multifamily, that it was a top multifamily market.
Oh, really?
I didn't realize that this was a good market to be in. I had no idea until I started learning about the thing. So when you're looking at multifamily markets, we're looking at some key fundamentals, right? And it's not complex. Again, we're looking for population growth. We want a lot of people coming into the market. We want job growth because we want those people to have jobs, right? So they can go to work, get paid, pay their rent. Right? We want diversified employment, meaning that you're not too concentrated in any one industry. So like we don't like a market like Vegas, for example, because it's highly concentrated in hospitality and tourism. And it's getting crushed right now. And it didn't do well during COVID. Whereas Phoenix was very resilient during COVID, right? Lowest job loss rate in the country. So job growth, population growth, the two biggest things. Then we want landlord-friendly state.
Not California.
Not California, yeah. No blue states, basically. So regardless of politics, we don't want to be in a blue state because if you're not paying your rent, I need to be able to evict you in 30, 45 days, right? Get them out. And then we want business-friendly states as well, right? And that's where investors want to invest in, right? And so Phoenix, you know, we were fortunate, especially when we got into it, just had this massive surge of people and rent growth and jobs coming in here, which really gave a massive boost, to multifamily.
Yep.
Right. And then same thing with Dallas. We like Dallas because Dallas and Phoenix are both top 5 in the country for job growth, population growth, rent growth. They're landlord friendly, business friendly. Those are the biggest things, right? And so, we went to Dallas because we've been buying a bunch of deals in Phoenix. We bought like 40 deals in Phoenix, right? And we have a ton of investors that are in like 10 or 15 different deals, right? And they say, hey, we like you got the way you guys operate. We like your communication. We want to keep investing, but I don't want to have so much money in one market. I want to be diversified, right? And we've been telling people for over 2 years, like, hey, we will expand another market, but we want to make sure that all of our systems and processes are built out so that when we do expand, we do it responsibly and you get the same type of result. So by end of 2022, we felt like operationally we were at that point. We had the same supply chain, same entire process to execute the same plan in Dallas. Another big reason we like Phoenix and Dallas is that we're focused primarily on 1980s vintage deals, okay?
1980 or newer.
1980 or newer,
Okay,
yeah.
got
So
it.
yeah, ideally 1980 to 2000, right?
Okay.
But the thing is that in the 80s, there was a Ronald Reagan tax incentive plan that gave tax credits to apartment builders. And they went crazy. And they just built a ton of apartments in Phoenix and Dallas. So my point in saying that there's a big inventory of these apartments that have not been turned over yet, which we can buy and renovate and increase the rents. We want to be in a big market with a lot of inventory to build scale. So like we like markets like Boise, Idaho, Salt Lake City. Those have really strong job growth, landlord friendly, big rent growth, but
Hey, real quick, I don't know if you know, but I have a totally separate YouTube channel that you probably haven't checked out before, and it's just called Austin Zaback. And I've actually started a new series on that channel where I break down wholesale deals, okay? Wholesale deals that we've done in our business, and I show you step by step how we got the deal, how we sold the deal. I break down all the numbers on the deal, and I even show you the HUD of the deal, so you know we're not playing around. Now, I don't know how long you've been following me, but I do anywhere from 1 to 2 wholesale deals every single day. And my goal is to get to 100 deal breakdowns on that YouTube channel. So definitely, if you haven't already, go check it out. I'll link it down in the description below. And without further ado, let's just go ahead and get back to the show.
there's hardly any inventory of apartments, right? So you can't buy a lot of deals and build scale, right? Like we're going to buy this year. We entered Dallas this year. By the end of the year, we'll have about 2,000 units in Dallas.
Wow.
Right. So we can gain scale quickly, right? Because there's a lot of deals that have not been renovated that we have runway to continue to do our thing. So that's kind of why we did Phoenix and Dallas. And then as far as the environment, so yeah, as you know, everybody knows, in March of 2022, the Fed started to do this aggressive interest rate hike, the most aggressive hikes since the 1980s, so in 40 years. I think they've done like 11 different hikes now, over 500 basis points. And so what it's done is that across the country, real estate values for multifamily are down at least 20 to 30% from where they were beginning of 2022. And the reason for that is because since the debt is so expensive, it's more expensive for buyers to borrow money, right? And so these real estate values for multifamily are so sensitive to interest rates. The biggest 2 factors of valuations are interest rates and your net operating income. How much money is that apartment producing, right? And so when interest rates go up, values go down in the short term. And so what that's done is it's significantly slowed transactions across the country, right? It's pretty much frozen transactions. In the first half of 2023 this year, I talked to a broker about this 2 weeks ago. There was only 19 transactions in Phoenix over 100 plus units.
Wow.
And there was like 150 plus the year prior. So it's crazy. We bought 2 of those deals. So it's like, the reason is sellers don't want to be selling right now and giving discounts to buyers, right? And we're the same way. We haven't sold a deal since the middle of 2022. Once the rates started going up, we're like, I'm not going to sell any of these deals right now and give a discount just to sell early. But we always want to be active. We've always been active on, both sides of the transaction, buyer, seller. Right now, this year is a really good opportunity to buy deals because it's completely changed to a buyer's market, right? And so the only people that are selling deals right now, there's 2 camps. Either they're feeling some type of interest rate pressure and they're distressed and they pretty much have to sell, or they've owned the deal for so long that they can still sell it. They bought it at a low basis. They could still sell it and get a decent return. So some examples. We bought a deal in Dallas earlier this year. The loan of their interest balloon payment was going to expire the next month. Like we closed right before their balloon payment came. They had to get out of the deal. We got it at a good basis, right? We're buying a deal right now where the sellers, investors are going to lose money because they're feeling the interest rate pressure. they're selling it to us less than what they bought it for just a couple of years ago.
And why is that? Just for people, and even me, the loan product that they got, explain what type of loan product would put them in that situation? Because obviously people are thinking about retail real estate, 30-year fixed mortgage, right? Yeah.
So they're not impacted, right?
Yeah.
Yeah, so good question, Austin. So basically the majority of loans that you use for value add, and this includes even the big private equity firms, which are the biggest owners of value add multifamily the last few years, have primarily used what's called floating rate bridge debt. Okay, and what that means is that basically they're going to finance all your renovation dollars so that you can go and renovate these units, and your interest rate floats over an index, like this, what's called the SOFR index, right? And then you're supposed to buy an interest rate cap, all right? So you mitigate against the floating interest rate. The reason people do floating rate debt, and we do floating rate debt as well, we've done both. We know the pros and the cons. Whenever you do a fixed rate loan in multifamily, whenever a lender gives you a fixed rate, they have exposure on there because they're guaranteeing your rate won't change. If interest rates go up in the market, they get hit with that, right? And so the way they protect themselves with fixed rate debt is they hit you with a really nasty prepay penalty called yield maintenance or defeasance, right? With most like retail or single family homes, you don't have a prepay penalty. You could pay off your mortgage at any point. With these commercial loans, they're trying to get a yield on it. So if it's a 10-year loan and you sell that deal after 2 years, you're going to have what's called yield maintenance prepay, which means you're going to pay the lender what they would have made for the entire 8 years when you want to sell the deal.
Wow.
So we bought a deal, as an example, we bought a deal in Phoenix in 2019 for $17 million. Renovated 50% of the units. We drastically exceeded our projections, doing a great job. 2020, we go to sell the deal 2 years later. We had a 10-year fixed rate loan with yield maintenance. We had a $3 million prepay penalty right off the top.
Holy cow.
Right out of investors' pockets. $3 million out of profits. So we're like, oh crap, we actually have to hold this deal 8 months longer, renovate more units, increase the value even more so that we can sell it and absorb this massive prepay and still net out over a 2x return. And we were lucky the market was strong, because if it's not, the prepay penalty can be so excessive that you may not be able to sell and get a good net return for your investors. And it also impacts your refinance proceeds. When you go refinance, if I have to pay this big prepay penalty to my lender, it bites into my new proceeds. And so people do floating rate debt because they have little to no prepay penalty. You can maximize returns on the back end. However, you have the risk of the floating interest rate, right? So you have to mitigate against that interest rate by buying an interest rate cap, right? And so the reason we're in a good spot right now, we've always bought 3-year caps, right? And we've always had lower leverage, typically 65 to 70%. Now we're buying deals at like 55 to 60% loan to value.
So you raise 45 to 50% cash in
down
the deal.
payment.
Got
Yep,
it.
those are all the investors. So
Sure.
if I've got 300 investors, I'm raising $20 million down payment. Like we're buying a deal in 2 weeks for closing. The deal I mentioned, 56% loan to value. So I have a 44% cash down payment, right?
Yeah.
And we're buying an interest rate cap where my max interest rate all in is 4.75% the first 3 years.
Got it.
Right, which is actually lower than what you can get on a fixed rate product right now.
Sure.
And so the groups that are in trouble took 80 to 85% leverage. Some of them bought 1 or 2 year caps, and those caps are expiring, or they didn't buy a cap at all. And then a lot of them didn't renovate any of the units. So like the thing is, a lot of people the last 5 to 7 years could buy a deal, call it value add, do nothing, and the organic rent growth took off so much that they could sell the deal a few years later and look like a genius, right?
Wow.
We've been benefactors of that too, no doubt. The market makes everybody look smart. But we've also been able to actually crank these units. We've renovated, 1,800 units just in the last 9 months. Most groups don't have the infrastructure to actually renovate the units at scale. So they didn't push rents. They were riding the wave of organic rent growth. Organic rent growth is gone across the country. The trailing 12 organic rent growth in Phoenix right now, negative 4%, which means if you're not renovating and forcing appreciation, your rents are actually coming down, right? So when interest rates skyrocket, you have to fight back by renovating and pushing rents and forcing the appreciation, right? And that's why we do value add.
Sure.
So it's groups that have high leverage, short to no interest rate cap, little cash reserves, didn't renovate. All of a sudden, they have this cap expiring and their rate's going to go up to 9%, and they got to get out of that deal.
Immediately.
Immediately.
Yeah, for sure.
So they have to sell for a loss. A lot of people are doing capital calls.
Yeah.
And so there's risk in these investments too. People need to understand, right?
Yeah,
and
sure.
So that's why when we talked about earlier, conceptually it is simple, but it does get complex, right?
yeah.
Like operationally, because there's a lot of things that you have to account for.
Oh,
you know,
a ton.
for sure.
Yeah, a ton that you have to learn and account for. I mean, it definitely would take time. If somebody ever wanted to go become Zach Haptonstall, I mean, it's not going to happen overnight, right?
Yeah, no, you got to partner with somebody smarter than you. Like that's what I did with Bikron.
Sure. Yeah. Is Bikron a partner in the organization?
Oh
now?
yeah,
Okay,
yeah,
awesome.
yeah.
Good
So
deal.
it's Bikron, Robert, and I are the 3 co-founders.
Okay.
And Bikron and I, kind of run company day to day. So
Got it. I love that. Yeah.
Yeah.
No, it's awesome. And what do you think? So what do you think about it? And correct me, is this the first time rents have gone down in like 20 years? I mean,
I believe so.
I don't-
I'd have to check, but yeah.
I don't think I've seen rents go down in forever.
I know. So yeah, it's a great question, Austin. So basically, Phoenix specifically was like number 1 in the country for like 3 to 4 years. So we saw the last 3 to 4 years from like, call it 2018 to 2022, like 30 to 40% total rental increase in a matter of 3 to 4 years. So we saw like this massive increase and we hit this baseline. So we have a larger baseline than most people, right? And what's happened as inflation has caught up to people, their groceries are expensive, their gas is expensive, that they can't afford the rents, when it starts to hit them. And so you have a lot of people, a lot of apartment buildings right now in Phoenix, the market has softened without a doubt. I mean, people are giving concessions left and right, giving specials. Like we have prospective tenants will walk into our offices at our properties, and we've got right now we have about 29 assets, 6,000 units in Phoenix.
Okay.
And they'll say, what's your special? What's your concession, right? And so fortunately, because we're renovating, we're still getting a significant increase. Like we've renovated over 1,800 units from January through now will be end of September, 9 months, and our average rental increase is over $450 a unit.
Wow.
Right, which is still above our initial projected rents, even with negative organic rent growth. But that's because we found deals that have below market rents, renovating to a higher level, and our average rent right now is about $1,280 a unit. So it's still affordable, right?
Sure.
But they're paying for this higher quality scope with stainless steel appliances, quartz countertops, etc. Most groups that aren't renovating to that level have the original 1980s finishes, old brown cabinets, white appliances, carpet, right? And so if you're not providing a better quality product, you can't push the rents, and the rents are coming down.
Sure.
Yeah. So that's kind of what we're seeing.
I mean, phenomenal perspective as to what's going on in the market, right? And I'm curious, like you built the property management, you have vertically integrated, the actual group that acquires the property and everything like that with the actual property management aspect. And correct me if I'm wrong, most people don't necessarily do that, do they, when they're going and doing what you're doing, or do they?
Yeah, good question, Austin. Yeah, so the majority of owners across the country, even the private equity firms, use third-party property management.
Yeah.
And we used to do that, right? But as we started to get bigger, I think we got to around 2,000 units, we started to realize we needed more control, over the staffing, over the processes, things like that. So it was a big undertaking. And starting a property management company and running a property management company is a pain in the ass. I'll tell you that. It is operationally intensive, right? Yeah. The national turnover margin for property management is 40% a year.
Wow.
And that's what we see, because these are a lot of like entry level, and I'm talking about like on-site maintenance, management. We have a lot of 6-figure salaried employees too that are like our regional directors, people like that. But yeah, you have a lot of, on-site staff. And so, but we don't regret it. Like we're very happy. And I think it's one of the reasons we're in a good spot right now is because we can, if we want to change our leasing structure to incentivize our staff, we can do that. Our biggest thing was when we were using third party, so to give you an idea, property management is a crappy business model. It's very low profit margin, right? And so most of these third party companies, they simply cannot afford to give better compensation, better benefits to their staff because they have a bottom line, because property management is their business model, right? So we were using third-party property management, and this was in 2021, the first half of 21, within a 5-month period, 4 different on-site managers they were working on our properties, they were third-party property management employees, get picked off by our competitors. They just show up and offer more money and they leave. And our property management company could not offer them better compensation because it didn't make sense for their business model. So our whole thing was, you know what? Let's start our own property management company, offer the best compensation, the best benefits to recruit and retain the best talent. So we cover 100% of everybody's medical, dental, vision, and 50% of all their dependents.
Wow.
And we pay, very competitive wages. So to our knowledge, nobody else does that. So now we pick people off from like these Class A property management companies to get better people.
Sure.
Right. So it gives us more control because we don't need property management company to be a big money maker. It is profitable and we make good money, but we just want to have the control because our big money, our high profit margin business is the investment company, right? So once I've executed the plan and I've renovated the units and I've done a good job operationally and I can sell it, give investors their money back, and then you and I as GPs make our sweat equity. That's where the real money is made.
Sure.
So the property management company is almost like, I don't want to call it a loss leader because it makes money, but it's just for control.
Sure.
Right. So that's kind of, it is more unique. It's a big undertaking, but when you're going to build a big portfolio, I think it's necessary.
And it is brilliant. And the fact that you were able to pull that off in the time that you did, I mean, it's truly impressive. I was telling you a little while ago, have roughly about 75 people who work in my organizations. And the fact that 240 full-time employees in a span of a very short period of time it is truly impressive that you were able to pull that off. And we don't have to go too deep into this because I know I do want to get you out of here in a reasonable time. But
sure, no worries.
I am curious on any legalities or red tape in running a property management company. Simultaneously, you're also the GP of the deals. How does that work? And is there any sort of disclaimers? I mean, how does the property management company get paid?
Good question.
If that makes sense.
Good question. Good question. So basically, the legalities are, typically, like we said, it is typically a third-party property management company, right? So you've got like an LLC that owns the property, and they're using a third-party property management company. The industry standard, if it's 100+ units, typically how it works is that the property management company is making 3% of monthly collections.
Okay.
That's their fee, okay? 3 to 3.5%. If it's a smaller property, that percentage may go up, but typically industry standard is 3% of monthly collections is paid to the property management company. We're charging 2.5%. Okay, so we actually charge a little bit less because it makes the deals pencil a little better and get more cash flow to help the investors. But whether you use third party or your own, you have what's called a property management agreement, which is basically like a contract between the owner of the property and the PM company, right? And so we have just a property management company with our agreement with ourselves effectively. Two separate entities, and then we disclose in our investment docs that this is what's called an affiliated entity, meaning we own it.
Yep.
Right? So, and all of our investors know. And from like a marketing perspective, it's not only does it give you an operational advantage truly to be vertically integrated, but investors like to hear that,
I'm
right?
sure.
Because a lot of our investors have invested with other sponsors that use third-party property management, and then when the deal's not going well, the sponsor's blaming the PM company, and the investor's like, I don't care whose fault it is, just make it work. You know what I mean? And so it's like, well, I can't blame myself, right? It's I own the company, so I have to do a good job.
Sure.
But it makes a difference because we've done things that other PM companies don't do. Like we have a whole full training program that we've built out. We have like a mentorship program, so the different things you can do. But that's kind of the legalities of it.
Sure. Yeah, no, phenomenal, answer there. I'm curious real quick, too, on what you think. And I know you very briefly touched on like Class A multifamily, right?
Yeah.
And Class A multifamily in particular going into a trending down market. Like, what do you see that being? I know, you've got a lot of guys that won't name names, but you've got a lot of guys that advertise and raise capital. Like, in just your complete opinion, obviously, do you have any predictions as to if interest rates continue to go up, like what Class A will look like in the future?
Good question. So I think in the long term, Class A will do well. And in general, when you're looking at those investments, a Class A investment is typically like a 10-year hold.
Got it.
It's like a 10-year horizon. If you're going to invest in a new build, right? It's like a Class A 10-year horizon, whereas our deals are typically, 3 to 5 year horizons, right? And so basically what's happened in Phoenix, anyways, I'll give you some anecdotal evidence here, is that the cost to build the last several years has been so expensive that the only way to make those new development deals pencil or make them work economically is you have to build like ultra luxury Class A to command premium rents, okay, so that you can justify all the costs to build it.
Like the Optima.
Exactly, yeah,
Right.
something like that, like these nice, exactly, like these Class A. Well, in a downturn like right now, there's a much smaller demographic of people or renters that can afford those Class A rents, right? And so we're seeing some of this new build, they're given like 3 to 4 months free concessions.
Wow.
Because they have to lease these things up, right? So they have to give these massive concessions. So I think, in the short term, in this high inflationary period, there's there's less of a demographic that can afford it, right? But the thing is too, is like whenever you're doing these investments, a lot of this comes down to what's called your cost of capital. And what that means is, what return do I have to get my investors to make them happy? A lot of the groups that are doing Class A, like institutional groups, they have a much lower cost of capital than us.
Got it.
What I mean is that they're raising money from like a REIT or like a pension fund, and they just want to park that money in something that's super safe, and they get 2 to 3% yield a year, right? Whereas with us, our what we call retail investors, like individuals, they want a much higher return, right? And so the only way for us to generate that type of return is we have to add the value. That's why we call it value add, where we're buying a deal, we're forcing appreciation instead of relying on organic appreciation. But we have a lot more execution risk because if we don't renovate on schedule, on budget, you could screw up the investment, right?
Sure.
So it's the traditional risk reward trade-off, right? It's like we have more operational risk because we have to like actually renovate these units. You know, you're dealing with a lower demographic of tenants, and so there could be more delinquency, you know, things like that. Whereas with the Class A, it's on autopilot effectively, right? But your return is much lower. And so it's tougher for us to go buy a Class A deal because we wouldn't be able to raise the money. Because investors are like, I don't want that crappy return, right? Whereas the institutions will say, I don't want your crappy property that needs to be renovated. I just want my safe little park this money in this 10-year investment and get 2 to 3% a year.
Got it.
You know what I mean? So that's kind of the trade-off there. So it's different types of capital. But I will say, like I said, I mean, the Class A in Phoenix anyways, there's so much new build was built recently. It's all competing against each other. And Class A competes with single family homes, like your space, right? Because people that can afford those Class A rents are kind of deciding, should I buy a house or should I go rent this luxury apartment for a year?
For sure.
Whereas our product, our demographic can't afford houses. That's just the reality. You know what I mean? Like they're not going to have enough cash down payment. They're not going to meet the debt to income ratio.
Especially not in the market we're in.
Especially now, with interest rates so high, there's no way.
Yep.
Right.
Yeah, very interesting. I'm actually one of the people. I mean, I just moved into the Optima right here.
Oh, did you? Okay,
Sold my house and moved into the Optima.
Yeah, so you're a perfect, you're a perfect example.
Perfect
of that.
example, you know. Hey, real quick, I don't know if you know, but I actually wholesale real estate nationwide, and I have buyers all over the nation looking for incredible deals. So if you're a wholesaler and you locked up a deal and you're struggling to find a buyer, I would love to partner with you up on it, and I would love to help you sell it. All you have to do is text me 480-418-5339 and just let me know that you have a deal that you need help selling. Again, the phone number is 480-418-5339. Let me know that you have a deal, you want me to bring a buyer. Somebody on my team will reach out to you right away, and we will help you get it sold. Now, let's just go ahead and get back to the show.
Yeah.
I drive a Tesla. My office is 1 block away from the Optima. I'm at Optima Kierland, you know.
Okay, nice.
And I'm like, why would I go buy a house right now, you know?
Right.
And I'm also in
Makes
real
sense.
estate, so for me, I gotta feel like I'm getting a phenomenal deal. I
Yeah.
wholesale every day.
Exactly.
So I'm like, I want to buy a house at 50 cents on the dollar if I'm going to buy, you know?
Right. You have a different perspective.
Right,
Yeah.
sure.
But still, you're a good example of that.
I am a good example, you know? And what is your prediction of the next 1 to 5 years in terms of interest rates? Obviously, you're talking, okay, most aggressive rate hike in 40 years.
Right.
You know, we're at now, I mean, what, the 10-year treasury, I think today was like 4.4, give or take. I could be wrong.
Yeah, I didn't look. Yeah, I think you're
right in that ballpark.
Yeah.
So, you know, what do you predict? I mean, not getting too deep, obviously, but,
Sure.
you know, we're coming up on an election year. I
Yep.
know that the election years typically can, you know, I would love to get your kind of opinion.
Yeah, no, it's a great question, Austin. So yeah, I mean, again, who knows what happens, but here's what I personally think. Like you mentioned, I think the biggest factor is the election year, right? You have, regardless of whatever your political views are, anybody listening, you have a Democratic administration running for re-election. And although the Fed is supposed to be independent of that executive branch, I mean, I don't know that I believe that, right? So I think that I wouldn't be surprised that in the second half of next year, maybe even Q2, a lot of people are projecting a 25 basis point cut like in March or April. But I think by second half of next year, you should start to see these rates start to get cut. I don't think it'll be significant. I don't think it's going to go back to where we were. But I predict, I mean, what do I know, right?
No, yeah,
But
your opinion.
my opinion is I think there will start to be cuts to make the economy look rosier, make this administration look good. I mean, right now, you know, they've gotten inflation down a lot. It's still not where they want it to be. And I mean, as the time that we record this, you know, Austin, I think just 2 days ago, they had their most recent September meeting and they came out, you know, kind of hawkish, you know, saying rates are going to be higher for longer. But the Fed has to do that, right? I mean, they're always going to posture because they don't want to make it seem like things are going to get better because then people will spend money and drive inflation back up. But I can say that I think by 2025, you know, going into, you know, Q2 2025, I think you'll start to see, you know, pretty significant cuts. Because like, I mean, we even look at this internally, like historically, whenever the Fed does these big rate hikes, it's typically followed by a pretty significant cut.
Sure.
And they might be doing 50 to 75 basis point cuts per meeting once they start to cut. And so I think that even over a 6-month span, 150 to 200 basis point cuts is not, you know, unreasonable.
No, I don't think so.
I think that could really happen, right?
Yeah.
So, I mean, I think the economy is performing better than they thought. But I also think there's like a bunch of misleading residual data that hasn't caught up yet.
Agreed.
Right.
Yep.
So
yeah, I'm excited to see what'll happen. I have a very, very similar opinion to you, if not identical. To what'll probably happen. You know, and I think a lot of people do too. I ask that question a lot. I always like to get the opinion, you know.
Right.
And the majority of the people I've had on are kind of leaning in that direction.
It seems like common sense, right?
Yeah.
But who knows? I mean,
who knows?
Last election year we had COVID. It was crazy.
Right. Yeah.
who knows
And
what
COVID
happened.
seems to come around about every 4 years.
That's right.
During the
It's
election.
a very cyclical type of virus.
It's very, very smart virus.
Yeah.
Well, real quick, Zach, I want to pivot it just for like 5 minutes, not even.
Sure.
You know, how do you manage it all, right? Here you are, you're a successful entrepreneur, you're married.
Yeah.
Do you have a family?
No, we're pregnant right now, though.
Congratulations.
Yeah, we're like 8 weeks pregnant.
Okay, awesome.
Yeah,
so you're about to have a family.
Yep, yeah.
So if you're not already dialed in, you're going to have to get more dialed in,
Get more
right?
dialed in, yeah.
And,
Yeah.
you know, how do you manage it all right now?
Yeah.
And how do you plan to manage it when you have the baby?
Good question. Yeah. So, I mean, I'm like a very boring person, right? I like try to honestly just stay super disciplined, consistent, and focused. So I'm like very regimented. Like I don't drink, I don't smoke weed, I don't do anything. You know what I mean? I'm just very boring. So I'm like, I basically drink water, coffee, protein shakes. I stick to my workout regimen. And like all we do is work, but we don't think of it as work. Like it's the whole cliche, you know, and we were kind of talking about this before we got on air here, is that like, you know, I work with my wife, you work with your fiance. So like our relationship actually started when this company was starting. So it's like we're almost intertwined into this. And this is what we're excited about. This is what we're passionate about. You know, my partner Bikram, same thing. You know, he's like, we're both in our early 30s and his wife works full time in the business. And so this is what we do. And I think, you know, as we continue to have kids, I think I'll find that balance. You know what I mean? I don't think there'll be an issue there because this is what we like to do. But yeah, I just try to eliminate distractions. And like, I can tell you now that we've entered Dallas, literally multiple times a week, I'm getting some type of vendor or like a broker inviting me to stuff. And I just almost turn down everything.
Yeah. Happy hour this, happy hour that.
Yeah, exactly.
Yeah.
There's happy hours. Like, let's go to the Cowboys game.
Yeah.
Sounds fun. But I don't want to get distracted because whatever I do then takes me away from my workout, which then there's always like this residual effect, right?
Yeah, tomorrow I'm tired.
Exactly.
The next day I'm tired.
Exactly, yeah. So I just try to stay laser focused on like, okay, what is most important, you know, as far as like operations, who do I need to be managing, finding deals, raising money, and just kind of rinse and repeat. And so I just try to simplify things.
Yeah.
Like I don't go to a lot of stuff. I kind of keep a small circle. I think publicly to raise money, you have to go to events. But like I spoke at an event 2 weeks ago here in Phoenix, and we sponsored the event. It's like a 4 or 5 hour half day event. I was busy working, so our team was there with the booth. I literally showed up like 2 minutes before our panel. I went up on stage, spoke on a panel for an hour, and then I left.
Yeah.
And the event was going on for like 2 or 3 hours after that.
Yeah.
So I didn't even spend time with the event because it's like I need to be laser focused on what is important.
Sure.
So I think, you know, it's a big thing I'm conscious of is as you get bigger, you got to keep the main thing, as they say, right? And just stay laser focused on, you know, don't believe in your own hype and what actually gets results.
Yep.
And I know what gets results, right? And it's like, it's the grind that people don't want to do. And it's like last night, I flew in last night, got to our house at like 8 o'clock. You know, I had to do some work and I felt like crap. And I went to the gym from 10 to 11 because I knew if I didn't go last night, I'm not going to have time tonight because I have to go to like my grandma's birthday dinner tonight. Yeah. And I was going to miss that workout. You know what I mean? It's a mental thing, right? It's like, it's just, if I miss that, then what else do I start to skimp on? So it's just trying to keep that consistency. You know what I mean?
I love that, dude. Such phenomenal advice too, by the way. And
thanks.
you worded it in a very perfect way, or I mean, a very awesome way, really, truly. You know, the most mundane life that you can live. When you look at the most successful people that I've interviewed and really that I've listened to, I mean, from Joe Rogan to Lewis Howes to, you know, Diary of a CEO, Stephen Bartlett. I mean, whoever it might be, you know, you hear from these big names, people, and they have a mundane life.
Very simple, vanilla, right?
Yeah.
Just stay boring because that's kind of what gets results over time.
Yeah.
Yeah.
You know, and I think people in the beginning of the journey of entrepreneurship and business ownership and things like that in 2023, people have the wrong idea of what it will look like.
Yeah.
You know, and I don't know if that's from like the rap and the music industry or where that comes,
right?
You know,
all the hype and like the money and the women and whatever you want to call it.
Not going to look like that.
Yeah, exactly.
If it does, it probably won't be sustainable.
Exactly.
At the end of the day.
You
get burnt out.
Yep.
You want like one or two final things. And one is, do you enjoy, like, how is it working with your wife, right?
Yeah.
There's a lot of people, and I just have to ask you because it's rare that I get to ask.
Right.
I do that, right?
Yeah, you're always one getting asked.
Yep.
Yeah.
And so how is that? Would you recommend that to other people?
Yeah.
And then I just have one more question after that.
Sure. Yeah. So, no, it's funny because you actually gave a comment before we started recording, and I agree with what you said, is that I tell this people too, is that people say, how is it working with your wife? Well, we've gotten, I'm not saying we're this very big company. We've gotten big enough where like my wife has like literally 5 or 6 employees that report to her directly, and she's our VP of marketing. And then I have like my staff and like the directors that I manage. And so like we don't interact a ton throughout the day because she's doing her thing and I'm doing my thing. But when there's like higher like overarching themes, like, hey, the security guard is creating issues or whatever it is, we're constantly talking about that stuff and can communicate. It's almost like communicating department to department.
Sure.
Right. So it's kind of fun because, it's not like we're like talking constantly, but we're always aware and have a pulse on what's going on in the company. Yeah. And so for me, it's fun. Like, and you said it best. We're like, you don't want to just wake up in the morning and you go your separate ways and you come back at night because if you think about it, you spend most of your waking life, your hours at work, right? And so that's kind of the cool thing. That's a blessing about, starting a business is that you have that control over your time and you can kind of be together.
Yeah, I love that, dude. And I think, honestly, anybody watching should take a good hard look really at, like, if you're going to build a business or a future entrepreneurship, you're going to get into any sort of that type of world. I really believe that the partner who you're doing life with, who you're actually sleeping next to, because you've got 2 partners in business, right?
Yep.
But you're not sleeping next to them at the end of the day, right? And I've got 3 partners. I own multiple companies.
Yeah.
And I'm not sleeping next to any of them at the end of the day, right? But the person I am sleeping next to, I want to make sure that we can build a cool life together. Right. And I really believe in that, man. And I think that
100%.
Some people watching, like, they're like, well, I don't see how you could do that. And to my response would be, you should take a good hard look at who you're with. If you can't spend that time with people.
No, dude, I'm with you. It's weird that people say that. And so like even like I go to Dallas every 3rd week. Grace come with me every single time.
Yeah.
Like we'll fly out on a Monday and then we come back on a Thursday or Friday.
Sure.
And I even told my partner Bikram, I said, Bikram, this is gonna get expensive with like food and airline because I'm gonna be like a 2x every time.
Yep.
But it's worth it because my marriage is the most important thing.
Sure.
Because if that's not there, then I can't focus on work and the company would fall apart.
Yeah.
Right. So that's kind of like the foundation and that's my support system. And that's the key thing. Right.
That's so powerful, man.
Yeah. And it's
all
real,
right, dude.
so.
Well, I appreciate you being here and taking the time. So final question, of all the things that you've learned in business and life, personally, relationally, spiritually, whatever it might be, right? All the knowledge and wisdom that you've, kind of learned over the course of your life. If you were to just leave maybe your future baby, he or she will be born in 7 months or so, roughly, right?
Right.
You could leave them with one piece of advice from everything that you've kind of accumulated over time, a piece of life advice or whatever that might be. What would it be?
Yeah, no, it's a good question. So the thing that I've learned, I'm going to go I know you asked one question, but I'm going to give a twofold answer here because this is what I started out with and I've consistently had to come back to as we face more adversity and grow is like, the first thing is to just like have faith in God because I'm Christian and like that's the biggest thing that like have faith in God because God does deliver. And I have never been like super, strict going to church. I grew up Christian, but as I met Grace, as we went through the adversity of starting this company, there's dark times where it's like I was broke. I was in credit card debt. You don't know what you're going to do. And you just, reach out to God and say, Lord, help me figure this out. And even now as we grow and we face challenges, I say, take this burden, God, and things always work out. That's the biggest thing. And the second thing is don't take crap from anybody. Like anybody who tells you can't do it, screw them, honestly. Like, because my whole thing is like, if you're going to tell me I can't do it, you're not the one that has to put the work in to get the results that I want. I'm the one that has to put the work in. So who are you to tell me what I can and can't do?
Wow.
Right? So that's the biggest thing is I hear it and I still hear it today. It's like, okay, you think I can't do it? I know the work that has to be put in. I know the grind that has to be put in. And I'm willing to do it. So just don't listen to what other people say, honestly. So like have faith, whether you're Christian, whatever your faith is, like just keep believing. If you stay consistent with something and you believe it will happen, it will happen. Yeah. It's just a matter of how long will it take. And then don't let other people tell you can't, because most people are going to tell you can't do stuff because they can't do it. They don't believe they can do it. So they get intimidated or they get threatened. And as you start to have more success, you start to get haters because you make people feel bad about themselves. And you can't let that, make you kind of reduce your level of your performance. So,
I love that.
So, yeah.
Phenomenal advice, man.
Yeah.
Wow. Truly phenomenal. Hey, if you're still listening, you're still watching, start it from the top. Rewatch the whole thing. I know I am. Where can people find you if they want to get a hold of you? Also, where can they find your organization if they want to invest money? How do they do that? And then, or potentially eventually look at your deals and just get a hold of your team in general.
Yeah, no, thanks, Sauce. Appreciate that, man. Yeah, so if you're interested, you can go to our website, rise48equity.com. So RISE48equity.com. You can actually set up a call with me. So there's like a link to my calendar. Set up a call with me anytime you're free. You can email me, Zach, Z-A-C-H, at rise40equity.com. You can learn about our deals, what we do, and we can add you to our list for future deals. So,
awesome. I love that. And then do you have any social media or anything like that? Do you like people to follow you on?
Yeah. So luckily, my wife and our team kind of runs a lot of the social media, frankly. But, LinkedIn, we're very active on.
Cool.
So you can kind of follow us on LinkedIn.
Awesome.
So,
I love that.
Yeah.
Thank you so much for being on the show.
Yeah,
I greatly
thanks, Austin.
appreciate it. Yep.
Of course. Appreciate it, man. Thank you.